A lot of people are asking the question either to themselves right now, or I've heard it often, based on these record low rates, should they refinance right now prior to interest rates rising? Hello there, and welcome to the VIP Financial Education YouTube channel, where we help you go further, faster financially. I'm your host, Michael Matthey. I've got some exciting things to talk about today. We're going to be covering, amongst other things, really record low interest rates right now. We did a video recently on inflation. We're going to talk about how those two are really interrelated. What we're anticipating happening here in the upcoming months with some great data from some economists. And then ultimately, a lot of people are asking the question either to themselves right now, or I've heard it often, based on these record low rates, should they refinance right now prior to interest rates rising? And I've got some very specific details on that. If you stick through to the end of the episode here, I'm going to give 9 tips on if you think that maybe a refinance might be in your best interest, 9 things that you really need to take a look at while going through that process. Inflation and interest rates are often referred to in what's called macroeconomics. Now, inflation is the rate that the price of goods and services go up. In the US, the interest rate, which is the amount charged to the borrower by the lender, is determined by the Federal Reserve, often referred to as the Fed. The Fed attempts to influence the rate of inflation by setting and adjusting the target for the Federal Reserve rate. This tool enables the Fed to expand or contract the dollar and the economy based on whatever their desired need and whatever their desired outcome would be. That ultimately targets an employment rate, stable economic growth, and stable prices. There's a general tendency for interest rates and inflation to have an inverse relationship. In the United States, the Federal Reserve is responsible for instituting the country's monetary policy, including setting the federal funds rate, which influences the rate that banks charge borrowers. In general, when interest rates are low, the economy grows and inflation increases. And conversely, when interest rates are high, inflation is low and the economy can often be stalled out. Exactly when we may start to see these rates rise is going to depend on a number of variables. One is the pandemic. Obviously, that's something that we're all engulfed in and have been for over a year at this point. Is how is the economy going to respond in 2021, for example, to that ongoing pandemic? What's that going to look like between now and the next handful of months? Obviously, that's going to be a key factor. But also things like inflation and the Federal Reserve's desire to keep interest rates low are obviously going to come into play as well, and ultimately affect mortgage rates, of course. Although some of these rate increases may seem small, they ultimately affect the long-term total payoff on your loans. For example, a 0.5% increase in interest rates on a $300,000 house on a 30-year loan, for example, that 0.5% alone would increase the monthly payments by approximately $81. And over the course of that 30-year loan, that $81 a month would ultimately lead to an additional $28,000 in principal that obviously that borrower would be required to pay. And that's just on a 0.5% increase in interest rates, guys. At this point, interest rates are still below 3%. So if you're in the market, for a new home, or you're considering a refinance, which we're obviously going to talk about in this episode, you can still get really, really good rates right now. However, interest rates are not the only thing to consider. You should absolutely check each loan estimate, because, even though the interest rate may be low, those are not always going to be the best deals for you. There's obviously going to be fees and other things that are going to be involved in that. So, interest rate alone should not dictate your loan product and ultimately where you end up taking your business. As of May 7th, 2021, the 30-year fixed rate mortgage is sitting right now, according to Freddie Mac, at 2.96%. Now, analysts are looking, ultimately looking ahead, as they're supposed to do as analysts. And according to Logan Matsushima, who's the lead analyst for Housing Wire, based on how low interest rates are in 2020, he believes we'll see the average mortgage interest rate inch upward in 2021. But it is difficult to see it going above 4% since we're still in the thick of the COVID-19 pandemic, he says. The COVID-19 crisis was a deflationary event that set bond yields and mortgage rates lower than they traditionally would have gone in a normal recession. Slow and steady growth of the U.S. economy will be the primary driver of higher mortgage rates next year. Guys, right now we're obviously in the midst of a big-time housing boom. It's hard to find inventory. People are overpaying for houses. Interest rates are at a record low right now. And any economist that's out there, and we talk about on this show all the time, is kind of staying ahead of the trends. Obviously, knowledge is power and being prepared, but if you take a look at some of the top economists out there, they're ultimately predicting that interest rates are going to have to rise. Again, there's so much money being dumped into, the economy, literally trillions and trillions of dollars. Inflation is going to have to go up, and ultimately, even though the Fed has a strong desire to keep it as low as possible to continue to stimulate the economy, at some point something's going to have to give there. So, some people are saying, towards the end of this year that interest rates may rise. Some are saying, Q1 of 2022. I'm probably somewhere right in the middle. If I had to predict right now, I would say probably Q1 of next year. I think that interest rates are going to have to go up in order to keep in line with inflation. And we're going to talk about and kind of dive into this refinance space right now. So guys, obviously historic low interest rates. There's some rules of thumb here. When and if and when it would make sense. It's really that 1%, and we're going to dive into that here in a second. But for those of you that don't have a rate that is at these historical low rates right now, a refinance may make really good sense for you. For others, if you can't get that additional savings, that ultimately that math problem is not going to work out. Maybe you're selling the house sooner than you would be able to recover upfront closing costs, then it may not make sense. So I'm going to dive into that here. In many ways, refinancing a mortgage is much easier than going out and buying a home, especially in this market. However, you should approach a mortgage refinance with the same methodology and same due diligence that you would on an origination on a mortgage. Obviously, paying attention to your refinance rate, any fees associated with that, and then ultimately how long you plan to stay in the home. One general guideline in order to refinance your home is if you can get an additional 1% savings with that refinance, then it's kind of thumbs up. If it's less than that 1% savings, you could obviously make some arguments either way for that. But if you use that 1% rule, typically you're going to be pretty safe. There's obviously going to be some other variables involved in that, and I've mentioned it a couple times now. How long do you plan on staying in your home? If it's only for a short window of time, a refinance is probably not going to make sense because, it's going to take some time in order to offset the closing costs that, most of these are going to have. Now, there's some refi products out there right now that can roll them into, your principal. You're ultimately still paying it at some point. There's some that are going to charge some zero closing cost fees, but there's other terms and conditions with those that you ultimately are going to want to be aware of as well. One way to calculate this is to take the upfront fees, even if they're added into your loan balance, like what we talked about with a no cost refinance, and divide them by your monthly savings. So if we're doing this graphic here, if you had a $10,000 in refinance closing costs and your monthly payment is $300 less, then it would take roughly 34 months or just under 3 years to hit your break even. So if you weren't planning on staying in that home for that 3-year window of time, obviously under this illustration, that refinance would make no sense. The loan's repayment terms are also going to affect your mortgage. The loan repayment terms are not only going to affect your monthly payment, but also your mortgage rate. Shorter term mortgages often have a lower interest rate than longer loans. So a 15-year mortgage will have a better rate than a 30-year, for example, if everything else is equal. The trade-off with the lower rate on a 15-year, for example, is that your monthly payments are going to be higher. So some people can kind of have that sticker shock, but others have that mentality that they ultimately want to pay down their debt sooner than later. And so on a 15-year AM, for example, you've got those higher monthly payments, but every month, obviously, a bigger chunk of that is going to be going towards your principal reduction, and ultimately you're going to pay that loan off much sooner. So ultimately, that decision needs to line up with your current financial situation and obviously your long-term goals. Here are 9 key factors you would want to consider when contemplating a refinance. Number 1 is going to be know your home's equity. Refinancing with little or no equity is really, really difficult or can be a challenge right now with conventional. However, there are some government programs available. Homeowners with at least 20% equity in the home are going to have an easier time than someone that's got less than that. But visit with your lender and ultimately visit with a couple of them, and see what your rates are. Obviously, you're going to get your equity position, based on the formulas, and, see if you're going to be able to qualify for a refinance. And then ultimately you want to shop that. It's just like anything else. one lender may give a better rate, more favorable terms than another. There's going to be a give and take on some of these, but ultimately do your research. Equity position is going to be certainly something that is going to have to be kind of at top of mind. If you've got a very little or no equity, a refinance, might be a little bit more of a challenge. Number two is going to be know your credit score. Ideally, a lender is going to be looking for, a benchmark of 760 or above in order for you to get the absolute best rates and terms. If you are less than that, you don't have to necessarily be a 760 to qualify. There's multiple sites out there right now so that you really know where you stand, before talking to a lender. You don't want to go in there and be surprised, all, excited about, doing a potential refinance only to find out that you've got a 600 credit score. That's not going to be very advantageous for you. So know your credit. Number three is going to be knowing your debt to income ratio. If you already have a mortgage in place, you may assume that it's going to be easier to just go ahead and get the refinance, but not only has the bar on credit really been raised by lenders, they've also raised the bar on debt to income ratio, and that's important to be cognizant of. So you may have a long job history, you may have money in the bank, you may have good credit, but ultimately the kind of math that the lenders are looking for is they want your house payment to be 28% or less than your gross monthly income. Overall debt to income ratio should be 36% or less is kind of that rule of thumb. So you may want to consider paying down some debt before you try and go down this refinance or even just an original purchase. Number four is going to be the cost of refinancing. So refinancing a loan is going to typically range somewhere between about 3 and 6% of the total loan amount. Again, this is something that you guys are going to want to actively do your research on, and you're certainly going to want to shop these from one lender to the next. These fees can ultimately be rolled in, to your mortgage, and you're going to pay them off obviously over time, so you're not coming out of pocket. But in many cases, these rates and terms can be negotiated up front with each lending institution. So, don't be afraid to get, one piece of information or one quote, and then you're going to take that quote to the next individual or to the next lender and see if they can beat that, and kind of rinse and repeat and do that multiple times. There's a lot of savings to be made out there if you'll just spend the time and obviously energy to go out and locate multiple lenders and really kind of pin them against each other. Number five is going to be the rates versus the term. While many borrowers are going to, really focus on these interest rates, it's also important to kind of know what your long-term goals are, to see which loan product is ultimately going to be the best fit for you. If your goal is simply to reduce your monthly payments, ultimately what you're going to be looking for is a mortgage product out there that's going to be a little bit of a longer term, but the lowest interest rate possible. If your goal and your desire is to pay less interest over the length of the loan, then you're going to ultimately look for the lowest interest rate. Of course, you're always going to be looking for the lowest interest rate, but to pay less interest over time, you're going to want the shortest loan term possible. And then obviously, even though you do want to pay it off over the shortest term as possible, you want to make sure that it fits your budget. You're going to have a little bit of a higher payment there because it's a shorter term loan. Obviously, shop for the best interest rates out there, but make sure that it's in line with your monthly budget as well. Number six is going to be refinancing points. Take a look at obviously not only interest rates, but you're also going to want to take a look at points, which is equal to 1% of the loan amount. Those points can often be used to bring the interest rates down. Be sure to calculate how much these points factor in. You're either going to be paying up front with your closing costs, or they can ultimately be wrapped into your mortgage. Number seven is going to be know your break-even point. And that's going to be, at what point does the additional cost of the refinance get canceled out by the savings, on the monthly payments? Because at that point, once you've hit that break-even, the monthly savings are strictly yours. Number eight is going to be your private mortgage insurance, or your PMI. And that's going to be applicable to people that have less than 20% equity in their home. They're going to have have a PMI policy. Now, if you're already paying PMI under your current loan, this may not and would not make a difference to you. And a lender can quickly calculate that PMI and what additional costs that would add to your monthly payment when you're talking to them. Number nine is going to be know your taxes. Many consumers have relied on mortgage interest deduction in order to offset or lower their federal income tax bill. If you refinance and begin paying less in interest, then your deduction may also decrease. Just be cognizant of that. That's obviously a variable that you want to consider when you're doing this math problem to figure out whether whether or not a refinance makes sense. However, it's also possible that the interest deduction may be higher, particularly in the first few years of the refinance, when the interest portion of the monthly payment is greater than the principal. And guys, always remember, just like every financial transaction, mortgage refinancing is its own living, breathing organism. There's a lot of variables, a lot of factors involved in it. Do your due diligence. Talk to a reputable lender, of course. We're always going to encourage you to start there. Do the math, do your homework, do your research. This is not something to be taken lightly or done on a whim. It really just breaks down to a math problem, and then ultimately based on, your long-term goals. Again, can't reiterate enough, if you're not going to be in the home long enough to offset your closing costs, a refinance is not going to make sense. If this is a, scenario where you're going to be in the home for, the next 5 or 10 years, or depending on what it's going to take to offset your closing costs. Right now, with record low interest rates, it could make a heck of a lot of sense for you to at least look under the hood, kick the tires, and take a look at this before interest rates do go up. And ultimately, they are going to go up. Again, guys, like we say a lot on this, it's not an if, it's a when scenario. You can follow the trends. It breaks down to, simple math and obviously the economy. So drop a like below, guys. If you're not a subscriber already, please go ahead and subscribe. We're always looking to get new folks on our channel, and hit that bell below, which is going to be a notification for you that every time we put out new and relevant content like this, you're going to be alerted by it. So that being said, thanks again for joining us today, guys. Until next time, make it a great day. Talk soon. Thank you.